Gerald Stack, Head of Infrastructure at Magellan Financial Group. Thanks for joining us, Stacky.
Thanks, Mark.
Here we're actually fresh out of COVID-19 lockdown in South Australia, so we're back in the office talking today about airport investments, very close to your heart, and also electricity investments, which form part of the universe for infrastructure, obviously. Let's start with airports. Can you give us a feel for how do airports actually make money in the first place? Where do they get the revenue from?
Okay, so there's really three main sources of revenue. The first is the aeronautical business, the second is the sort of commercial business, and the third is property. So aeronautical, every time you use an airport, whether you're taking off, whether you're leaving the airport or arriving at the airport, you pay a fee to use that airport. Typically that's bound up in the ticket price, so you don't actually see that, but so the airline's sort of essentially paying that on your behalf, but you're paying a fee. So that's what we talk about as an aeronautical income stream. Yeah. Clearly, the number of passengers flying to the airport, and there's a price. So the more passengers, the more revenue you get. So that's the first one. The second one is the sort of the commercial income streams, which is sort of the shopping centre and the car park. Again, this is linked to passengers. So typically in airports, the way that the shops pay rent is linked to either the total revenues that they generate or the number of passengers going through the airport. So either way, passengers, again, are a key driver of that. So you've got aeronautical, you've got commercial, the third income stream is property. And then if you think about airports and the businesses that they support, there are a number of businesses who want to be located close to the airport in either offices or warehouses or industrial type properties. So, freight forwarding businesses, a lot of government businesses want to be close nearby. So this is just a straight rental business. But again, in the long run, this is very much linked to passengers, because the more passengers you have going through an airport, the more businesses that want to be close to it. So ultimately, passengers are a key driver for rental as well. Very much a key driver in the short term. Short-term fluctuations in passengers drive both aeronautical and commercial revenues, but also in the long run, it also drives rental revenue. So three different revenue streams, but all linked in some way, shape or form to passenger numbers.
Which we'll come back to in a second. But just before we do, the regulatory regime is different for different airports around the world. Would you be able to touch on the different regulatory regimes as well for us, and perhaps link it to Sydney Airport as an example?
Yeah, okay. So the regulatory regimes are either what we call single till or dual till. In single till, the entirety of the airport, including the property, including the shopping centre, including the aeronautical, including the car park, all of the earnings get regulated, okay? Or they all come into a bucket. You deduct costs from those revenues, and the airport is allowed to earn a fair return. And a fair return, as we might say, that's sort of 9 to 10%, something around that range. And what they do is they price their aeronautical passengers, the fee that you pay for the aeronautical service, they price that so that the airport in its totality makes approximately that fair return, give or take. So that's a single till. The entirety of the airport gets regulated, essentially. For dual till, they split the airport into essentially two tills. Yeah. One is the aeronautical and the rest is everything else. And the aeronautical fee gets set such that the aeronautical returns, so the aeronautical revenues minus the aeronautical costs, the aeronautical profit, as it were, such that is a fair return on the aeronautical assets, which is the bulk of the assets, the runways, the terminals, and the like. So in that case, that part gets regulated, and the rest of it, the shopping centre, the car park, the properties, the airport can make out like a bandit.
Right.
And so in a single till, the entirety of the airport gets regulated. In dual till, you split it in two. One part gets regulated and the other doesn't. Now, Sydney is dual till. Right. And like most things in the world where you have two differences, there are very few airports who actually sit at either end of the spectrum, who are either pure single till or pure dual till. Sydney and Auckland, actually, are about as close as you get to being pure dual till. That is, they have relatively unobtrusive regulation. The regulator tends to stay out of their affairs. They need to make sure that they don't abuse that monopoly power that they have on the aeronautical side. But provided they do that, the regulator, since privatisation anyway, has tended to stay out of their affairs. So that they are quite pure dual till. And that dual till is the most investor-friendly type of airport for us, whereas Heathrow in the UK is more pure single till. Other airports are somewhere between the two.
So that would explain why your investments in airports at the moment are Auckland Airport and Sydney Airport. Would that be?
Yeah. So what you tend to find, Auckland and Sydney, we like for a number of reasons. One, we like the regulatory regime, and we like the regulatory regime because it means that if passengers are growing, that on that part of the airport that's not regulated, you can do pretty well. So we like that. We also like the fact that both Sydney and Auckland are relatively high growth destinations that had 4.5%, 5% growth per annum, probably over the last 20 or so years. So that you're growing passengers at a reasonable clip. Because if you think about revenues, you're going to grow at volume plus the price increases you put through. So you're probably going to get inflation basically on price. But you're going to get arguably 5% volume growth plus, let's say, 2% inflation, and you've got 7% revenue before you've done anything. So as you're getting out of bed in the morning, you've grown your revenues at 7%. You can do additional things on top of that, but you get that 7% revenue growth. So we kind of like that. In addition to which, both Sydney and Auckland have significant international passengers, in particular from China. And Chinese international passengers are highly valuable. They spend a lot of money on duty-free. They spend a lot of money on FX. These are very high margin businesses for the airport. And Chinese passengers in particular spend more than average. So that's a particularly valuable component. And that's what we've liked about Sydney and Auckland in the past, and we will continue to like it. It then just comes down to a question of whether or not it's priced in the price we're paying.
Have you got any sort of stats, or anecdotal evidence of the difference in spending levels from international passengers to domestic passengers going through Sydney, for example?
Yeah, so when the stats are old because we haven't got a lot of international passengers at the moment. In the past, the number has been that international passengers, Chinese passengers in particular, spend about 4 to 5 times the average of an international passenger.
Right.
Extremely valuable passengers.
And the average international passenger would spend how much more than a domestic passenger? Forget about the Chinese just for a second.
Well, now, if you're talking about someone using our domestic terminal rather than our international terminal, which, domestic passenger versus international terminal, basically around about 60 to 70% of the revenues that Sydney Airport earns outside of the rental business, so in the commercial and in aeronautical business, around 60 to 70% of revenues come from international passengers versus 30 to 40% from domestic. On the flip side, international passengers account for about 40% of the passenger mix. So they're 40% of the passengers, let's call it 70% of the revenues, which gives you a sense of how important they are.
Yeah, that's great. Thank you. And you've also explained why you like airports in the first place, which is passenger growth and them not essentially.
If you think about our universe as utilities and infrastructure, utilities tend to get regulated at the point of earnings. So your earnings is there, you earn that 9.5% return. You're not going to do too much worse than that. You're not going to do too much better. There's essentially a collar around your returns.
Yep.
So that's utilities. In infrastructure, it's price that gets regulated. It's the price that you pay to use the airport or the toll that you pay to use a toll road. So that's what gets constrained or regulated. And therefore, if we can identify assets in the infrastructure space where volume is growing over the long term, then yes, price is regulated, but total revenues and total earnings are not. And therefore, you can earn a high and growing return on capital over time. So we like airports because A, they've got a relatively fixed cost structure. Their costs don't grow with passengers as much as revenues do. Same goes for toll roads. Same goes for communications infrastructure. You have a relatively fixed cost structure, but your revenues can grow over time, and hence your cash flows that are coming to shareholders can grow at a reasonable clip over the longer term.
In the shorter term, of course, passenger numbers are off something like 97%, I think, at Sydney Airport, the last numbers that I saw. So why on earth, Gerald, would somebody want to buy an airport now?
Essentially because we all believe that people will travel again. So if we felt that the current set of circumstances if this was going to be what airports face for the next 20 years, I don't think anyone would be touching airports with a 10-foot pole. But we're all relatively confident that people will travel again. If you think about the travel mix, there are really 3 types of travellers. Leisure, people going on holidays, visiting friends and relatives, and then business. Now, all the studies that have been done through the pandemic would suggest that people are very keen to travel again for leisure, for holidays. They're just busting at the gate to do so. Similarly, for visiting friends and relatives, that's a source of demand that really doesn't go away. People are there, indeed, the people who have travelled when quarantine is open, it tended to be dominantly visiting friends and relatives, going to see their families. So leisure and visiting friends and relatives, what we talk about as VFR, very stable sources of demand, and we expect that to come back pretty quickly. Clearly, it relies upon a relaxation of the quarantining and improved health outcomes. Vaccines are going to be important for all of this, but given the news we've had on the efficacy of vaccines, I think we can all be reasonably confident that's going to happen pretty quickly. Let's say over the next 3 to 4 years or so. The final piece is business. Now, business travel is a lot more uncertain. Here we are today. I normally come and visit you 2 or 3 times a year, Mark. Here we are today doing this on Zoom. And this is not dissimilar to what I've been doing with investors all around the world over the past 6 months. So to the extent that Magellan is symptomatic of most businesses out there, or businesses who transact across borders, we're suddenly finding that there's all these tools that are at our disposal, which they're not as good. I don't have the pleasure of your company face to face or in person, but we can still have some level of effectiveness of what we do. So we do expect that businesses will travel less going forwards. How much, we can't be 100% sure, but we do expect they'll travel less, and that's a part of the demand for travel that we suspect is not coming back, or it's gone away. Business travel will grow again. It will return to 2019 levels, but it could be some time. Now, roughly 25% of travel is business travel globally. So it's not the dominant component, but it's a material component. And, whether or not we lose a quarter of it or half of it, we can't be really sure. Indeed, we might not lose any of it. It might well be that businesses decide that actually the face-to-face contact is really kind of important. But there's clearly a risk that it doesn't come back quickly. So that's the piece we've got to worry about. Now, what we've seen to date is the worst month for travel was April this year. In April, global travel was down about 95%. International travel globally was down 98.5%, and domestic travel was down about 87%. So pretty stark sort of numbers. And what we've seen from April onwards is just a gradual recovery. Now, the most recent data we have is for September. This is IATA data. The IATA is the International Airline Alliance, lobbying group. And so the IATA data has shown a progressive improvement in the number of people flying each month. And I think in September it was down 72.5% versus September 2019. So it's still pretty ugly. Let's not gild the lily on that. But we are seeing green shoots. We are seeing people come back. And this is an environment where, we don't have a vaccine and there's still pretty significant quarantining out there. So we're seeing that people, we certainly don't believe travel's going away. We think it's an essential service that's provided to community. So it's absolutely relevant and appropriate that it should be part of infrastructure. They're facing a one-off, well, hopefully a one-off situation. And that's going to mean that it's going to hurt them for a period. But we're pretty confident that they will come back. Now, IATA's suggestion, really, estimate, if you like, forecast is that passengers will return to 2019 levels in somewhere around 2023 to 2024.
Yep.
The airports have typically been a little bit more sanguine than that. They're typically saying sort of 2024 to 2028, something in that period. So there's a reasonable degree of uncertainty about the way aviation recovers, and the depth and duration of any recession that flows from the pandemic will be key to all of that, combined with the way that business returns. So there's some uncertainty. We have about 6 to 7% of our portfolio in airports. Prior to the pandemic, it was more like 18 to 19%. So we're being cautious. I expect we will go back to airports in time because we do like the business model, but we want to have a high degree of confidence about the way that develops.
Yeah, good answer. A lot of negativity in the valuation piece though at the moment, isn't there? You're talking 23, 24, and the airport's talking far longer than that. There's a lot of bad news already baked in. So
absolutely. I mean, it's certainly arguable that the airports are that some of the airports, not all of them, well, on our analysis anyway, are looking pretty cheap. If you assume that numbers come back by 2023, 2024, there are certainly some airports out there that look pretty cheap. But the reality is there's a wide range of outcomes here. There's a high degree of uncertainty. And we're spending a lot of time trying to see, how confident can we be? Well, what does the worst outcome look like? And if you assume that worst outcome, does the airport still look cheap?
Yeah.
We haven't been adding to our portfolio in the airport space in the last little while. But that's the essence of what we're trying to get to.
Okay. One final question, Gerald, on airports. On the negative side, a lot of commentators talk about debt levels in airports as a deterrent to investing in that sector. How do you think about that?
Well, it's like in Australia, when commentators are talking about high debt levels, they're talking about Sydney Airport.
Yes.
It's like any group of assets or group of companies, you're going to have a range of different debt levels, and Sydney is higher than most airports. Until the pandemic, they've never really had a debt issue. In fact, they've never, to my knowledge, I haven't looked at this for a little while, but over time, I don't think there's been any 12-month period prior to the pandemic where traffic had gone backwards. They've always found, over any 12-month period, passengers have continued to grow. Clearly, that's not going to be the case this year. So they are incredibly robust and reliable income streams. And that's, in essence, that's why they've been able to carry high debt levels. At the end of the day, the people granting them that debt, the banks and bond holders and the like, are not silly. They're expecting to get repaid, and history would suggest that they will get repaid. It's a very powerful franchise that they have. They have high earnings levels, high earnings margins with some degree of growth, and that's been able to enable them to reduce their effective gearing as measured on income levels progressively over time. So it's something it's absolutely worth looking at and being concerned about from time to time. But you'd have to say that over time they've been proven to be good capital managers in terms of their own balance sheet.
Okay. That is an excellent flyover view of airport investing, Gerald. Thank you for that. From one spectrum of infrastructure to another, we're going to talk about electricity now. So when people turn the lights on at their home or turn the air conditioners on, there's not much thought goes into it other than expecting that the lights come on. Of course, we all know behind that there's essentially three areas of electricity. You've got the generator, which generates electricity. You've then got the retailer, whether it's AGL, Momentum, Origin Energy, who sells it to you. And then you've got the part in the middle, which is the distribution businesses, which gets the electricity from the generator to people's houses. So out of those three, as an infrastructure investor, which of those bits are you attracted to in the electricity sector?
Okay, so for us, definition is kind of important here, how we define infrastructure. So for us, infrastructure is not defined so much by the physical characteristics of the asset and more by the risk and return characteristics. In other words, but most investors, when they think of infrastructure, they use the term essential assets that provide services that are essential for the efficient functioning of communities. And really what that means is because they're providing energy or water or transport, there's very reliable demand for those services over time. So that's key, and that's interesting. But what we think investors ultimately want out of infrastructure is sort of no excuses returns. They want to be very confident about the nature of the returns over time. So it's about high degree of confidence in return, and therefore relatively low levels of risk through the economic cycle. So that's important because when we come to think about utilities, as you mentioned, there's really three distinct parts to the industry. You generate power, you send that power down the poles and wires, and then someone sells you the power. Now that first bit, generation, in Australia in 2019, the wholesale price of electricity in Australia fluctuated anywhere between $14,000 a megawatt hour and negative $500 a megawatt hour. So you got this highly variable price. The average price was about $90 a megawatt hour, different in different states.
Negative $500 a megawatt hour, was it?
Yeah, but negative 500, where at the low, where the companies were electricity generating companies were essentially paying you to run your air conditioner or whatever.
Yeah.
You've got this highly variable price. Highly variable price means ultimately highly variable revenue and highly variable earnings. So generation for us doesn't meet that criteria of being very reliable and predictable in terms of the risk return characteristics that we expect. Poles and wires, well, they're natural monopolies because no one wants two sets of them to, in order to enable competition. So you've got a natural monopoly providing an essential service, and not surprisingly, it's regulated. And many investors, when they hear regulation, they run for the hills. We run towards it. We run towards it because when times are tough, it means you can sit down with your regulator, and because there's an underlying agreement that the regulated utility is allowed to earn a fair return. It won't exploit its monopoly, but it's allowed to earn a fair return. That when times are tough, you can enable yourself to continue to earn that fair return. And indeed, we've seen that this year, that these entities have continued to earn exactly what we'd expect. So generation, we don't really want to be in. Transmission and distribution, absolutely, that's where we want to be. Retail is, again, not really for us. And reason being, it's competitive. Most of your clients will have had a call from a retailer at one point or another, probably on a Wednesday night at about 7:30, offering them the chance to switch their supplier, probably for a $30 fee or $30 incentive. Now, that's wonderful as consumers that you're getting a bit of competition. But as investors, we don't really enjoy that, particularly as an infrastructure investors. We don't want that pressure on margins. We just want a reliable, predictable, boring life, essentially. So we don't want to be in retail. We don't want to be in generation. Where we want to be is in transmission and distribution. And our underlying test is that 75% of the earnings, if we're going to call you a regulated utility, 75% of the earnings have got to be in that transmission and distribution space. Well, essentially, they've got to be regulated. And that kicks out around about 100 companies. There are about 100 utilities out there that operate across the space, but they earn less than 75% of earnings from regulated sources. And what we're left with is about 70 companies,
Right.
70 to 80 companies in the utility space. So there are more utilities who fail our test than meet our test.
So your main message with electricity is boring is good, basically, and you want to leave the exciting bits to somebody else.
Yeah, look, as a broad message for infrastructure generally, boring is good. Boring is beautiful. We don't want too much excitement in our life. 2020, way too much excitement. We just want reliable, predictable earnings. Where it's certainly not get rich quick, this stuff, but you should have, as an investor, have a very high degree of confidence over a 3 to 5 year time frame that you're going to get a fair return. And we remain pretty confident about that, even in the case of airports. 2020 has been an ugly year, but taken over a 5 year time frame, the returns have been okay, and we expect over the next 5 years they'll be okay as well. In the case of utilities, that's exactly what we want. We don't want too much excitement. We want just reliable, predictable earnings, essential services. They should be relatively low risk. And they should, on that basis, you should be very confident as an investor that, as I said, you're not going to get rich quick here, but you are going to grow your wealth with a very high degree of confidence over a sort of a 3 to 5 year time frame.
The classic risk-return trade-off, isn't it?
Yeah, exactly.
One of the things you touched on was regulation. I guess that's a double-edged sword. That's certainty, but also potential for risk as well.
Absolutely.
It's related to one of the investments that you have in the portfolio that's Australian-based, which is Spark Infrastructure. Spark Infrastructure owns distribution assets in Victoria and South Australia. We have clients in both jurisdictions. So South Australia is SA Power Networks.
Yep. And
I think in Victoria it's Powercore.
Yep.
And are you able to just walk us through the regulatory framework, just at a high level, of how the regulatory environment works for Spark?
Yeah, they also own, I might add, transmission assets in New South Wales. So they're in both transmission and distribution. So how does regulation work in Australia? Really the same way it works in most jurisdictions, and that is that the regulator allows the company to price its product, the transmission and distribution of electricity, such that it earns a fair return on its cost of capital. Now, every 5 years, the regulator reassesses what a fair return is, and they set that return for the next 5 years, and they work backwards. So that, let's say in the case of Spark, that they look at their regulated asset base, the amount of capital they've got invested in their poles and wires, and they'll say that's something like $10 billion, and they'll say that they're allowed to earn around about an 8% return. So $10 billion, 8% return, they're allowed to earn essentially $800 million after tax. Now, they actually work on this pre-tax, but for this purposes, let's say that's what they're allowed to earn. So they're allowed to earn $800 million. That Spark then adds back all the expenses to work out what their total revenue is. So normally a business would work out its, we'd go and manufacture a good or provide a service, price that, and whatever it can make out of that, that's its revenue. It then deducts its cost to work out profit. That's a normal business. For a regulated utility, you start with profit. You know what your profit is based upon the value of your assets, the value of your capital base, times your allowed return. So in this case, they know it's 800 million. They know what they can estimate what their expenses are. So they add back those expenses. The expenses plus profit has got to equal their total revenue. Then they divide that by the amount of electricity they're going to supply to work out the price per unit of electricity. So they work backwards. And they do that every 5 years with the regulator. And that sets what they're allowed to earn for the next 5 years. Does that make sense?
Yep, absolutely it does. And I believe that's just happened for Spark's assets in Victoria and South Australia, hasn't it?
Yeah. So as I say, every 5 years, and the regulatory determinations have just come through.
And so really that means that with Spark that we're talking about, you've got very much regulatory certainty for most of the investment asset for virtually the next 5 years.
Yeah, you should be very generally pretty confident about the way things are going to play from here. Now, in Australia, they do this in real terms, which means that they strip out inflation. So inflation can move you around. Inflation's probably a good thing for Spark. So the low inflation is that we're currently experiencing is not exactly what Spark wants. They wouldn't mind a little bit of inflation because that means your revenues go up and therefore you can pay a slightly higher distributions. But nevertheless, so inflation's a little bit of a moving target. Spark will need to execute on its operating costs and its capital costs. They've got a very good track record on that. They've done an outstanding job of that over time, but they'll need to continue to do that. And they've got significant capital expenditure program as they move forward over the next 5 years. So there are some things that can move this around, but they have essentially certainty on pricing, which is the major area of risk, really.
Just want to touch on two other risks, Gerald. One is the risk of people exiting the grid. So Spark gets paid for connections to the grid.
Yep.
So as opposed to usage, it doesn't, as in my understanding, it doesn't matter how much electricity people use, they get paid per connection. So in terms of people disconnecting from the grid because they've got solar panels and a battery, how big a risk is that, do you think?
So it's a long-term risk, if you like, because the less people who require, if they don't need to be connected to the grid, then eventually there's a grid that continues to need to be upheld, and the utility needs to make a fair return. There's less and less people to pay for that, then that's a bit of a problem. We think that's a pretty low-level risk. It's not apparent to us that it makes a lot of economic sense to go off-grid. To the extent that people go off-grid, they normally doing so to sell power back to the grid. That's part of the economics of making it work. Well, if you're selling power back to the grid, you've got to be connected to the grid. Yes. So, you're unlikely to, it would appear at the moment it just doesn't make economic sense to invest in multiple batteries and solar cells and the like, solar panels, without actually selling electricity back to the grid. What it does do is give you reliability. So I suspect we will find in the coming years. Well, if you've got your own backup batteries, and then if we have blackouts or brownouts, then you have your own source of electricity for 2 or 3 hours or something. So that does make sense. But as a pure economic decision, it doesn't seem to make a lot of sense to us just at the moment to own all that equipment. Yeah. So we see very little risk of that.
No risk there.
We do expect that we've seen studies that show us that utility scale batteries can make a lot of sense. For example, the Tesla battery in South Australia, where really what they're doing is they're playing the pricing curve over the course of the day. So if you've got sufficient tech to enable you to watch the pricing curve, buy it when it's cheap, sell it when it's expensive, then yes, you can make some money out of that, and that tends to flatten the curve over the course of the day. So that can make money, but that's at a very large scale. It's very difficult to make that work, I think, at a household level. So we don't see a significant risk of people abandoning the grid based on available technology. It doesn't mean that it can't happen in the future, but we certainly don't see it at the moment.
One of the other things that's on the horizon, which will affect electricity and potentially distributors, is electric cars.
Yeah, absolutely.
They're low level, but accelerating now in terms of take up. What impact is that likely to have on a poles and wires business?
Yeah, the electric cars would be unambiguously good for the poles and wires business. One, because they'll consume more electricity, so there'll be more electricity coming through the system, and therefore the average charge can reduce. Which the average charge is paying off those poles and wires. So if you've got more volume coming through, you can reduce that transmission component. So that would be good. In addition to which, cars would work as a battery. They would essentially enable electricity to be stored and then released in peak hour potentially each evening. So there are a lot of good things about electric cars. We haven't seen, that would require significant investment in the network to make it smarter, to enable it to deal with the complex demand profile that utilities are going to have to deal with. So there's going to be some investment required, but that to us looks like a very positive outcome.
And I guess that's the heart of the question: the investment required. Is that going to come from government, or is it, or investors going to be asked to put their hand in their pocket? Is it going to be I guess what I'm really getting at is it going to be a cost to Spark investors, or is it going to be an investment that they can recoup through higher charges or government?
Yeah. So we do expect it'll be an investment for Spark, and we think that's a wonderful thing because in a regulated system, they'll get a fair return on that investment. Otherwise, they won't invest in the system.
Yeah.
So we should embrace that. It may well be that governments look to reduce the cost of that investment through tax incentives or the like. Either way, it doesn't really matter. From Spark's perspective, or investors in Spark, the perspective of investors in Spark, any capital investment into the system will get a fair return. And provided we get that fair return at a revenue level, then we'd be very comfortable with that. And indeed, as we look around the world, this is a significant opportunity for utilities everywhere. That every utility we look at around the world is looking to increase the rate of penetration of renewable energy. But in most jurisdictions, renewable energy is cheaper than fossil fuel based generation. And if you're reducing the cost of the generation, then that enables you to reduce the cost to customers and therefore to invest more in the network to make it more reliable, to make it more efficient, to make it more environment friendly over the long term.
So in a nutshell, Gerald, what should an investor expect out of investing in electricity assets such as Spark Infrastructure? We're using that just as a pin-up boy today, but
in infrastructure generally, our view is that you should be looking to achieve inflation plus sort of 4 to 5%. So if we talk about inflation of 2 and plus 5% on top, we're talking about returns of the order of 7% per annum. At the current time, we're looking at yields, income yields is around about half of that. So capital growth of about 3.5%, income of about 3.5%, give or take. And that comes out of our cash flow based methodology. We expect that should be consistent. That's been a view that we've held for a while, and we see no reason why that won't change. So that's infrastructure generally. And utilities are entirely consistent with that. We would expect utilities to make returns of that order over the longer term.
And Spark have declared that the distribution rate for this year, is 13.5 cents, which would imply something slightly north of 6% income return.
Based on current share price, yep.
Can you comment on, so the current share price is just a touch above $2. Can you comment on sustainability of that distribution? How are you looking at that?
Yeah, on the basis of our forecasting and modelling, we'd expect those distributions to grow something in line with inflation over time. So we'd expect those distributions to be very much sustainable, and provided they're efficient in the way they spend their capital costs and their operating costs, and they finance their requirements in an efficient manner. In other words, getting the cheapest possible debt. We'd expect those distributions to continue at that sort of level, plus and to grow at inflation, or indeed potentially slightly more than inflation over time.
Okay. So again, boring is good, but boring with a 6% income rate that's sustainable doesn't sound too bad to me.
Yeah, no. But I would say that absolutely, it's part of our portfolio. We clearly like it. We're a significant shareholder in Spark. Where we find these companies who are yielding higher, then almost by definition, we expect less capital growth out of them.
Yes.
So we're expecting, let's say in the case of Spark, 7 to 8%. If you're getting 6% yield, we're expecting lower levels of capital growth out of Spark over the long term.
No, good answer.
There's no magic pudding here, unfortunately.
No. We're not looking for pudding today, but just good, solid investments. We've gone through 2 sectors which are highly likely to produce that going forward for investors. Thank you for taking us through airport investing and electricity in a very easy to understand manner. Very much appreciate your time.
No problem, Mark. Nice to see you.